Hello, everybody. Luke Gromen, FFTT. Hope you are well. Hope you are having a great week. Last week was off family vacation down in lovely Charlotte, North Carolina, near the Lake Norman area. Beautiful area. Hope everybody had a great week. It is awesome to be back in the saddle. Excited to be here. Thank you for the questions. Always enjoy these interactions. So let's jump right in to try to keep things as tight as possible. First question is from Jonathan. Luke, Trump has been on and off regarding tariffing imported gold. For now, he's off. Can you explain why the back and forth and why he landed on no for now anyway? In my opinion, there's a variety of possibilities. I don't have strong conviction on either or any of them, but let me lay them out. Either he didn't know any better, and so he decided this was a good idea without sort of knowing all the details. And then backtracked once he learned that it might not be a good idea. I think the second possibility is he did it knowing some of the details, knowing what the reaction would be, which would be gold going up quite a bit, quite potentially. And someone that we'll call Kaiser Soze, in reference to the great movie The Usual Suspects, essentially told him and his administration that no, you cannot do that in no uncertain terms. And I'm not saying by any sort of threat or anything. I'm just simply saying there are still rules, and there are rules that even he is subject to. And the Kaiser Soze would be the managers of those rules. And we can have a debate or discussion around whether those are high-level global finance people, banking people, Bank of International Settlement. Who knows? But that's second option, is Kaiser Soze told him, no, you can't do that. The third option is that he did it and then reversed course simply to try it out. See what the reaction is. See what the market reaction is. Offer some market participants a chance to get on sides if they were short gold, to introduce this as a potential possibility. Because ultimately, we've talked about over and over that ultimately the U.S. may need to revalue its gold, which is valued at $42 an ounce on the books. And that revaluing it higher would automatically create a deposit into the Treasury General account, free and clear for Besson to use for lots of different things, which is very useful for a country and for the United States in particular in increasing the acute fiscal and debt problems. And so revaluing gold, increasing a deposit into the TGA, you don't have to sell any gold to do it. It's just an accounting entry that creates dollars by using the gold instead of having an offsetting debt that you have to issue to get those dollars. This would be a way for the U.S. to get the price of gold a lot higher before revaluing the gold. Right? Ultimately, a 39% tariff on gold, price of gold should go up 39% in U.S. dollars. And if they do that, then call it $4,500, $4,700 gold versus $3,400 today. You'd be putting like $1.5 trillion almost, $1.2 trillion, $1.3 trillion, I guess, $1.2 trillion into the TGA. Besson could then go, hey, I got $1.2 trillion sitting here. I don't have to issue any long-term debt for the next 2 years at all. And so then they could cut rates. And while everybody thinks that rates are going to take off when the Fed cuts rates, when the Fed cuts rates, what if the Fed cut rate 50, 100, 200 basis points? And Besson goes, we're going to revalue the gold. We're not going to issue any long-term bonds for the next 2 years. Guess what's going to happen to long-term yields? They're not going up. I don't think they're going to go up much at all. They're going to go flat to down. And so I don't know which of these options it is. I don't know if he just didn't know better and had to backtrack. I don't know if Kaiser Soze told him to backtrack and he did, or if this was just a test of the emergency gold revaluation system for those of us that are old enough to remember watching TV and getting those things periodically on TV on Saturday mornings or what have you. So, as I like to say, let's watch. From Jason, in modern times, deflation has been seen as more of an evil compared to inflation. Perhaps since inflation is seen as annoying, but the system survives, whereas with deflation in a debt-based system, too much of it brings the system down. What happens when you're in a country like China, where deflating assets back that back debts, we're deflating asset-backed debts that are owed to state-run banks. Is deflation as dangerous then? China's a bit of a special case in the way it is structured, which I mean, by which I mean you have state-owned banks, state-backed developers, state-backed debts. So that's two sides, right? That's creditor, debtor. State-backed banks are the creditor. State-backed debts are the debtor. If one defaults on the other, who takes the loss? They're both the state. Nobody does. It's like if a tree falls in the forest and no one hears it. Did it make a sound? However, as many rightfully point out, the currency would take the loss, right? All else equal, the currency takes loss. That's where China has sort of structured itself as a special case. They've been very smart about this. The Chinese, the PBOC and the CCP clearly seem to understand this because of how they've structured the system. You can see it by how they've done it. What do I mean? They've got capital controls, right? So the currency would take the loss in theory, but you have capital controls, so you can't have capital flow out. Currency isn't going to flee when that happens. Okay, well, that's not exactly true. They have very strict capital controls, but gold they do have an open capital account on a limited basis under certain conditions for foreign creditors around gold. And the Chinese government, as far back as 2002, with the PBOC, have been encouraging Chinese citizens to buy gold for almost 25 years now. The Shanghai Gold Exchange is a division of the PBOC. I didn't know that until, 6 months ago, but it's true. So think about it this way. In theory, state-backed bank, state-backed debtor defaults on the bank, both state-backed, no loss. There's no ability for currency to flow out except on a limited basis through gold, but you've already preloaded your citizens for 20 years with gold. So the only way to get capital in any real way out of China is for the price of gold to go up a lot in Chinese yuan. Well, what happens if gold goes up a lot in Chinese yuan? Well, the gold that all its citizens have been front running for 20 years goes up. Their balance sheet goes up in yuan terms. It's very elegant. You got to give it to them. It's very elegant, particularly when you then layer on something we have been talking about ad nauseum for years, which is this would still be a problem for the Chinese yuan relative to commodity prices and then relative to their dollar-based FX reserves if commodities could only be priced by the Chinese or bought by the Chinese in dollars. But they don't. This is why the yuan oil contract and the yuan commodity shift has been such a big deal, why we've been harping on it. Because now, if you had gold prices go up in Chinese yuan, as I just described, for the reasons I just described, and oil and other commodities were only priced in dollars, then you're going to get basically commodity, high inflation, hyperinflation debt crisis in China. But with oil and other commodities priced on the margin in yuan, it doesn't have to be the majority, it just has to be on the margin. Now what that means is the price of gold goes up in commodities. Gold buys you more oil and copper and everything in China. And now it becomes a virtuous cycle for the Chinese consumer and standard of living vis-a-vis commodities while deflating their debt bubble. It's very, very elegant. You have to tip your cap. And it's a reason why I continue to say the Chinese have way more staying power than most naysayers have been saying for 20 years. Gold is a very powerful weapon, particularly when you're trying to compete against a reserve asset like long-term treasury bonds. Gold beats bonds. It's like, rock, paper, scissors. Like rock beats scissors every time, over time. So at any rate, some things to think about and chew on that front. Ultimately, I think it's one of the reasons I'm so bullish on gold is the way the Chinese are so elegantly using it and reattaching it by virtue of this to commodities. You're basically net settling yuan commodity-related imbalances in gold. And so that means you basically have global commodities on the margin bidding gold. Oil market alone is still some 5, 10, 12 times bigger than the global gold market in annual physical dollar terms. And so guess what? Gold to oil ratio goes from 8 barrels an ounce in 2008. It's 53 today. 53 barrels an ounce, up 7x almost in 15 years. Okay, next question from Mark. Luke, isn't there a point where layoffs would diminish the passive bid, resulting in a market crash? How would Treasury and the Fed respond? In theory, yes. When you talk about the passive bid, he's talking about just the mindless sort of weekly, biweekly paychecks diverted into 401ks, etc. problem is that it would also tank U.S. tax receipts very quickly, both from the employment side and from the stock market side. And since as we sit here today with receipts at all-time highs, with stocks at near all-time highs, with home prices at near all-time highs, with employment still very good, U.S. true interest expense today is over 100% of all those all-time high receipts. Despite all that, the reality is if you had a rollover in employment and a rollover in stocks, the U.S. true interest expense would quickly be well above receipts. In other words, interest, entitlements, Veterans Affairs. Putting the U.S. into a position where they have to choose. Cut Veterans Affairs, cut entitlements immediately, cut interest rates, print money, or default. Default ain't never going to happen. And politically, we would have a revolution by the weekend if you cut entitlements or you cut Veterans Affairs. Guess what they're going to cut? What are they advocating for? Powell cutting rates aggressively? Why do you think that is? This is why this is. They're already over 100% of true interest expense. They need to. They have to. It's the only thing they can cut. And so ultimately, that's what they're going to cut, one way or another. However that is chosen to be structured, there's a number of different ways they can do it. But in my opinion, for the average investor, I'm not talking about the pro who has a monthly mandate or a quarterly mandate, but for the average investor, it really boils investing down to simply keeping oneself more liquid than the U.S. government. All you have to do is survive longer than it takes for the U.S. government, the U.S. Treasury bond market to dysfunction in a market sell-off or a slowdown in the economy. Because essentially, the only way you lose at that point is if the government stands aside and says, you know what? Either we're going to cut entitlements and Veterans Affairs aggressively, not interest expense. Come on, that ain't going to happen. Or they're going to stand aside and say, you know what, we're just not going to pay the interest on the bonds this month, this quarter. We're going to default. Come on, that ain't going to happen. So they're going to do something quickly. So it's about managing that timing for the average investor, in my opinion, until they come in and re-inject dollar liquidity to keep the Treasury market from dysfunctioning yet again, which it has done 5 or 6 times since 2019. And when I say dysfunction, the easiest definition, you're going to have a spike in Treasury volatility, you're going to have a spike in rates into a slowdown. We saw it in Liberation Day. Remember that? Hey, everyone looking around going, hey, the dollar's going down, rates are going up, stocks are going down. What's happening here? If you like that, you would love what would happen if they decided to stand aside, which is why they won't, and which is why they didn't at post-Liberation Day. It took them 6 or 7 days. From MF, do you think oil is being artificially suppressed, or is it a lack of demand, or both? What's your target for oil over the next 5 years? Does the copper to gold ratio mean anything to you like it does to Jeff Snyder? Regarding oil, no, I don't think it's a lack of demand. I mean, I think demand is over 100 million barrels a day globally. I don't think it's being artificially suppressed per se. I think what it is tie back to what we were talking about with China and how they are using gold to gain the ability to buy oil in yuan. I think oil prices doing what they're doing are in no small part a symptom of multi-currency oil pricing. Oil's being priced globally in dollars still mostly, but on the margin in Chinese yuan. And with net gold settlement, as we discussed in the case of China, that means the release valve to inflationary pressures, et cetera, which from 1973 forward was oil, right? Through, call it 2018, 2020, 2022. We can debate that. But ultimately, when you had inflationary pressures, deflationary pressures, oil up, oil down, oil is very volatile. When you're on a gold standard prior to 71, oil was not very volatile at all. Gold flows, because gold was also fixed, gold flows were in theory volatile under the gold standard. What's volatile now is the gold to oil ratio. Gold to oil ratio has gone from 8 barrels an ounce to 52 barrels an ounce in 7 years, or excuse me, in 17 years. It has gone from 20 barrels an ounce to 52 barrels an ounce since Russian FX reserve sanctions were introduced in 2022. And so when you say, what's my view of oil? I think oil's price will grind higher with the highest cost marginal barrel of oil supply, which is U.S. shale. So basically, what that means in English is oil prices will move slowly higher over time on average in order to keep U.S. shale online with some acceptable level of profit margin. And I think the release valve will be the gold to oil ratio, which has already gone from 8 barrels an ounce to 52 barrels an ounce over the last 17 years. I think it's going to go to 75 barrels an ounce, and I think it's going to go to 100, and I think it's going to go to 125, and I think it's going to go to 150, 200 over time. I'm not saying it's going to happen overnight, but I think that's what's going to happen over time. Regarding copper to gold ratio and whether I think of it the same way as Jeff Snyder, without knowing specifically, I think he's saying it's a sign of a slowing economy or a coming crisis. I don't know for sure, but for me, it's just a symptom of multi-currency copper with net gold settlement, same as oil. Chinese can buy copper in Chinese yuan now. They net settle in gold. As more copper and gold on the margin are settled on a net basis in gold, oil and copper markets are way bigger in annual physical production terms than gold. And so what should you see? You should see the price of gold rise versus copper inexorably. And you look at a copper to gold chart, it's down and to the right. Some interpret that as, oh gosh, a crisis is coming. I think it's the monetary system changed and went into turbocharge change when we froze Russian FX reserves in 2022. Copper to gold ratio is down to the right since then. It's exactly what you'd expect. Gold's being moved back in as a reserve asset, and copper and oil are way bigger than the gold market is. So guess what? Gold to copper should go up. Gold to oil should go up. I think gold to most commodities will go up over time in coming years. And so that's my view of it. And then finally, from JT, what is your assessment of China taking advantage of their monopoly on rare earths to make a move against Taiwan? When is the earliest they could be ready to make that move? I don't think they're ever going to make the move. Like, why? What? They're winning. And they're winning over time via commercial business relationships. Like they don't want a conquest in the Western sense. They want to do business. They want to grow commercial relationships. They want to grow profits. And I think what the rare earth situation does is it gives them time. They can be patient. They have been patient. I think they will continue to be patient and just grind it out over the next 10, 20, 30, 50 years. And we're going to wake up around the mid part of this century and go, they have subsumed Taiwan via commercial relationships, via doing business with each other, not via some, hey, they invaded and took it over militarily, because that doesn't help anybody, least of all them. Not only does it make them the bad guy globally, but it also disrupts semiconductor supply chains in a way that it's like pulling out the bottom Jenga block in the world economy. It doesn't help anybody. So I think the Chinese, as a rule, have a pretty good sense of second derivative implications when they do things. I just think culturally, in my experience, they have shown a better ability to appreciate those things. I do think the U.S. is getting better at it under the present administration than prior ones, but we'll see. But I don't think China's going to invade Taiwan anytime in the near future. And for those reasons, I just think they can afford to be patient. They've shown they want to be patient, and they're winning via commercial economic relationships. So with that, I'm going to finish up. Thank you for joining me today. As always, if you like these updates, check out FFTT-LLC.com for more information about our tree rings product. 10 most interesting things, brief synopsis about what grabbed our attention about each, whether it is either confirming or changing a way we had been previously thinking about the world. So with that, everybody have a great rest of your week, and look forward to chatting with you all soon. Take care, everyone.